Starbucks stock is finding itself in the dumps. So what's going on? I'm Nick and this is the Dividend Growth Income channel. And today we're taking an updated look at the world's largest coffee retailer and asking the big question. Is Starbucks still a buy for dividend growth investors, or is it time to move on? Now I'm making this video as a current shareholder of Starbucks. I took up a position last year in our public dividend growth income portfolio. Today, it makes up about 3.2% of that portfolio with 16.35 shares. It's not a huge position for me. It's valued at just under $1,500. I'm up about 20% on it. My cost basis is around $75 per share compared to today's share price of just over $91. That's not too bad, holding it about a year. I took advantage of a major dip back in May 2024, and I really only added when it falls into that range. The sentiment around Starbucks right now is, let's just be real, it's awful. And yes, we knew this was a turnaround play, but with global sales declining for 6 straight quarters, it's time to reevaluate the position and take a closer look at what's really going on. I mean, some other dividend investors here on YouTube have already made the decision to cut their positions in the coffee giant, like Ryne Williams, who's never made secret his affection for the brand. And then you have Russ over at Dapper Dividends, longtime friend of the channel. I'll leave links to both of their channels in the description, and you can hear their reasons for yourself. But I think in both cases, it's safe to say they were able to put their emotions aside, and this is really important. And they simply asked a question, is this the best place for this money to be invested right now? And that answer led them to sell out of their positions. Now, as for what I plan to do with my position here in the portfolio going forward, we'll just keep watching, okay? Now, it's no secret that Starbucks has been a strong dividend growth stock over the past decade, delivering consistent annual raises, often in that double-digit range. Over the last 5 years, the dividend has grown by an average of more than 9% annually. More recently, last October, they announced their 14th consecutive annual dividend raise, this time at 7%. That's not too shabby, although it is going down slowly but surely. But given the company's current situation, it is fair to ask, is this kind of dividend growth sustainable going forward? And could the dividend itself even be at risk of a cut? Now, right now, the dividend makes up the entirety of forward earnings and free cash flow for the next 12 months. Free cash flow per share sits at $2.47 per share, while the dividend is $2.44 per share annually, leaving virtually no wiggle room for anything else, whether that be share buybacks or reinvesting in the business. Simply Safe Dividends currently assigns Starbucks a dividend safety score of 60, rating the dividend as borderline, suggesting a moderate risk of a dividend cut. And that rating was reaffirmed just a few months ago at the end of April. And it is a stock they have downgraded over the last year here. In reality, this is a company that hasn't been doing great ever since that pandemic, which at this point, we're talking 5 years. Take a look at the return on invested capital chart here. While a current ROIC of 50% is acceptable for a business like Starbucks, that long-term trend is what's concerning to me. It's been steadily declining over the last half of the decade, and it's only getting worse. Margins are also under pressure. Starbucks is currently operating with an operating margin of just 11% and a free cash flow margin of around 6%. Again, the trend here is not your friend. Combine that with 6 straight quarters of declining sales, and it's clear this isn't just a short-term bump in the road. There are some real fundamentals that have been eroding. And despite my own decent timing, an investment in Starbucks over the last 5 or even 10 years has been pretty disappointing, lackluster, you could say. If you include the dividend, total return over the last 5 years is just 33%. Compare that to the nearly 104% return investors could have by simply holding an S&P 500 index fund over the same period. Stretch that out 10 years, and the numbers still are not flattering. A 10-year hold on Starbucks would have delivered around 90% total return, while the broader market returned about 260% over that same time frame. It's a huge gap, and it highlights just how underwhelming Starbucks has been as an investment over that time frame. So I can absolutely see why some of our friends have made the decision to sell out of Starbucks and have moved that into what they see as better opportunities for their capital. And honestly, shares of Starbucks don't even look particularly cheap today. In fact, I'd argue they are overvalued based on forward PE. The current PE ratio sits at 38.9. And this is dramatically higher than the company's 5-year average of 28.8. Keep in mind that 5-year average already reflected a bit of a premium. Now, I'm not against paying a premium for a premium brand. It's part of the deal with a name like Starbucks. But in this case, the valuation has simply gotten too elevated for the fundamentals we're looking at today, and I couldn't call this a buy at these levels. I'm not buying it at these levels. Now, if you care about dividend yield theory, then Starbucks shares don't look quite as bad right now, right? The current yield of 2.68% it's a bit higher than the 5-year average of 2.2%, which could suggest some undervaluation from that perspective. But with the dividend safety currently kind of in question, I think this signal is a lot less meaningful than it would be under more stable conditions. Or should I say, just because the yield is elevated, it doesn't automatically make it a bargain, not when free cash flow is this tight and the payout is barely covered at this point. But I mean, Starbucks as a company is still one hell of a powerful brand, and that's been a major factor in my decision when I bought the stock and why I continue holding the stock. And as of now, I am staying in the position I'm holding, but I'm scrutinizing it closely, and I want to see some real signs of a turnaround over the next year. This means improving margins, stabilizing sales, more sustainable, growing free cash flow. That said, with a 20% gain on the table, selling and reallocating those funds into something with a bit more stability is definitely an option I am open to, especially with the stock looking overvalued. I'm not quite ready to pull that trigger though, like some of our friends have. Now, I've only held this position for about 15 months, and when I bought in, it was with the intention of holding it for the long haul. I don't want to sell out of Starbucks. It still has the brand strength, I believe, to pull off the recovery, but they need to execute. So I'm going to be patient for the time being, see what unfolds over the next few quarters, and we're going to keep you guys in the loop as well. So let me know down in the comments, are you a Starbucks shareholder? What do you think going in, the last half of 2025, the outlook from your point of view? I'm rating the stock a hold right now. If you want to check out what else is in our dividend portfolio, just click into this next video. I do go over the stocks I purchased and the dividends I collected in the month of July. Portfolio review video. Thanks for watching, and until next time, keep investing.